Coming up on the program, pockets of pain. Some prices are rising sharply, but inflation is still well below the Reserve Bank's target.
To lay a brick used to be about $1.30, $1.40 a brick. Now to lay them are around $2.50, $3 a brick.
And cotton comes alive. Growers set for a bumper season after rain revitalises the land. Also on the program, the pandemic accelerates the shift to online banking, leaving country towns without a branch. But first, AMP bosses faced angry shareholders at the firm's annual general meeting this week. The financial giant has been plagued by scandals, with a revolving door of executives since the Banking Royal Commission. Daniel Ziffer looks at the current state of AMP.
AMP shareholders are stuck in a nightmare.
Well, there are so many problems.
AMP does not have an identity at the moment.
Over the past 5 years, the value of AMP shares have fallen from nearly $6 to just over $1. The latest CEO is walking out the door, and there's big questions about the company's future.
Absolutely chaotic. We've seen changes in chair, changes in CEO, we've seen various directors departing and issues all over the paper every day.
Once a pillar of Australian business, the wealth manager is now facing tough competition from larger and leaner operators.
Revenue is problematic at a time when costs need to be reducing, and unfortunately they're not reducing fast enough.
Its new chair, the third in 3 years, essentially offered the entire company, or its parts, for sale. The only suitor, US-based Ari's management, dropped the idea. Now, AMP will spin off its most profitable division, AMP Capital.
All I can see at the moment is profit continuing to decline in Australian wealth management because of the shrinking distribution and the brand damage.
Brand damage is an understatement. At the Banking Royal Commission, AMP revealed it lied to regulators and charged deceased clients.
Charging premiums for life insurance to someone who's dead. That's the position, isn't it?
Yes, that's the way the system is treating it today.
The chair, CEO and half the board left, but it didn't stop the scandals. The new board approved the elevation of Bo Pahari to run the company's star division, AMP Capital, despite having docked his bonus over a sexual harassment complaint. Mr Pahari was demoted after the scandal broke and will now leave as AMP Capital is spun off. Reports suggest he could get a $50 million payout.
I think it would be fair to say that they've been engaged in an almost full-time crisis management since the time of the Royal Commission, if not earlier.
David Hazeldine was an AMP financial planner for more than a decade. He's part of a class action of company representatives who claim they were axed and paid a fraction of what their businesses were worth.
AMP are stealing their business and their livelihoods and throwing their reputations in the gutter in the process.
Despite angry investors, AMP executives managed to avoid a second strike on their pay report at Friday's AGM. Daniel Ziffer watched the meeting. Dan, what was the tone of the meeting?
Combative. The shareholders, who were meeting virtually, lobbed very difficult questions for the board and in particular new chair Deborah Hazelton. Issues as varied as the slumping share price, the strategic direction of the company, some of the scandals that we've seen around executive departures, and overall just the transformation of the company into a sustainable model where it can actually start making real money. AMP's profit this year was just under $300 million, down around a third of the year before. But there's bigger questions about where the company is going. They're currently spinning off their most profitable division, AMP Capital. That will be sold and gone after a year-long kind of courtship that ended with the buyer not being interested in any part of the company.
Despite some of those key complaints of those shareholders, the board avoided a spill. What are those complaints and why do you think shareholders didn't vote for a second strike?
It's been such a chaotic year for AMP that I don't think people wanted to see the entire board gone again. They're on their third chair in 3 years. Their CEO, Francesco De Ferrari, will leave with less than 3 years as well. New CEO Alexis George, currently second in charge at ANZ, inherits some really huge challenges. Now, some of those scandals that we've seen throughout the year that have further devalued the company, which was trading at record lows this week, have included the elevation of Bo Pahari. He was in AMP Capital's business. He was elevated to run the business, despite the board being aware that he'd had a substantial proportion of his bonus docked due to a sexual harassment complaint. When that information became publicly known, the fallout amongst staff and investors created a situation where it was obviously untenable. He was demoted, and now that the business is being spun off, he will leave. But he will leave with probably between $50 and $70 million in payout. That figure wasn't disputed by the board today, although much of it will be paid not by the company but by the funds that are going to mature. That is a huge amount of money when you consider that AMP itself only made around $300 million in profit this year. So huge questions about some of the missteps that have been made and about the direction of AMP now that it's getting rid of its most profitable division.
Now, the new CEO coming from ANZ has a big task ahead of her. Is the number one trying to shift that culture?
I think that will be a huge part of it. The outgoing CEO called it the toughest job in corporate Australia, and it's hard to disagree. Alexis George, who is still at ANZ and won't start until September, says the first thing that she'll do is listen. And she'll have a lot to listen to from staff who are aggrieved about terrible decision-making within the company, about shareholders who are perplexed by a slumping share price and seemingly very little of a way out, and for an overall investment community who are looking at as this business transforms when key parts of it are in really difficult straits. You know, financial planning, very difficult to make money out of in a legally compliant way. That was something that led to a lot of the issues we saw at the Royal Commission. And in the other aspects that AMP competes, well, they're beset by rivals who are either larger than them and better at it, or leaner, the digital natives who don't have the kind of costs involved that AMP does.
The cost of living in Australia is rising, but only just, with inflation numbers coming in much weaker than expected this week. While some sectors are seeing a rise in prices, this could just reflect a short-term spike and not the longer-term inflation picture. Business is booming for Perth builder Frank Letizia.
You should be right in saying that for a bit, I see. Yeah.
But with so much construction, it's hard to get his hands on supplies, and when he does, the prices keep going up.
Already this year, what are we in, nearly May, we've seen 2 price increases come through, and some are just hitting us with like a 7 or 8% price increase effective almost immediately. Bricks
have seen some of the biggest hikes.
To lay a brick used to be about $1.30, $1.40 a brick. Now to lay them are around $2.50, $3 a brick.
The latest inflation data shows some of these increases, but the true numbers have been masked by government grants. Spending in the home maintenance category rose in the March quarter. Construction of new dwellings rose almost 2% if you take out the impact of government grants like Home Builder. Across the country, rents have been dropping, skewed largely by falls in Sydney and Melbourne. But in Darwin, rents have been soaring, surging more than 16% in 12 months.
Luxurious formal dining. Prices have certainly increased, and they still have been on the increase because the demand has been very strong.
Darwin's rental vacancy rate is less than 1%.
It's been a welcome increase for Darwin, and Darwin's becoming more vibrant again because of it.
Overall, the March quarter inflation was muted. The biggest lift came from transport as we spend more on fuel, and health as changes to the PBS took hold. Annual inflation coming in at just over 1%. In fact, the RBA's preferred measure, annual core inflation, was the lowest on record.
Today's data would have confirmed what they expected to see, so there weren't really any big surprises in it.
Today's numbers keep annual inflation still well below the RBA's 2 to 3% target range needed to move interest rates. But groups like Westpac are lifting their 4-year fixed mortgages as global money markets push rates higher. It appears retail banks don't think the RBA can keep rates on hold for another 3 years. Dr Hunter expects to see the real fireworks next quarter, when we'll see a recovery from the COVID-impacted childcare and fuel prices a year ago.
Those two things alone obviously have now reversed, and at the time put a big drag on inflation last year. And so the kickback from that will be headline inflation very likely above 3% in the June quarter.
So get ready for some serious catch-up in the next round of data. Premier Investments has made a bold move in the retail space, poaching JB Hi-Fi head honcho Richard Murray. Mr Murray will leave the electronics retailer in August after 18 years with the company. At Premier, he will head up the retail business, including Just Jeans, Portman's, Peter Alexander and Smiggle. The news of the departure wasn't welcomed by JB Hi-Fi investors, with shares experiencing their biggest intraday drop in nearly 6 months on Wednesday. Hundreds of bank branches are shutting across Australia as the shift to online banking accelerates during the pandemic. The closures once signalled a town in decline, but now the industry says it's just a sign of the times. But in some regional towns, locals say their loyalty is being tested, as Stephanie Chalmers reports.
Heading southwest along the highway from Bathurst in New South Wales, you hit the town of Blaney. It's got a pharmacy, a post office, pubs and restaurants, and until recently, 2 major banks.
How often would you use the bank branch here?
Probably at least 3 times a week, and that includes paying bills.
National Australia Bank has already closed. The Commonwealth Bank will shut in June.
We can get a limited amount of change from the post office, but then other than that, I guess they'll have to go to Bathurst or Orange, which is like half an hour drive either way.
Tammy Mobbs works at a bakery on the main street of Blaney. Her older customers are hesitant about their ability to do all their banking online.
Some people still don't have internet to their house. We haven't had the FPOS facility for very long, but since we've had it, people struggle even with the tap.
30 kilometres on the other side of Orange is Molong, and the last bank branch here is slated to close in June. It's a decision that won't only affect this town, but residents across the Shire.
The online petition now has 1,166 signatures. So, you know, we've just got to fight harder.
They've tried it in other branches and it hasn't worked.
Mayor Kevin Beattie has taken that fight to the top of the Commonwealth Bank, holding talks with its boss, Matt Common.
Instead of just a straight closure, is there an alternative? Can we have the branch open for a couple of days a week, 3 days a week? Share that with Blaney.
The Commonwealth Bank has told the ABC there's been a 45% drop in transactions at its Molong branch over the past 5 years.
They're saying that they're taking into consideration COVID, but I also raised the point that prior to COVID, we've just gone through 3 years of drought. We weren't directly affected by the fires here themselves, but we were affected by smoke. A lot of our wineries lost their crops last year through smoke taint.
Farmers in a drought, they do not spend money. They don't come into the bank. Because simply they're there day in, day out, feeding livestock.
Now the drought has broken and COVID restrictions have eased, Molong's enjoying a surge in tourists.
Since people haven't been able to travel overseas, they're coming through the west here and they're staying. Definitely a lot busier now. Not having the banks is going to be a big hassle for me.
The head of the bank lobby says branch closures no longer signal a town in decline as they once did.
What we're seeing now is more than half the branches that are closing are in the middle of capital cities or major regional centres where there's population growth. So this isn't about population decline, it's about a really big shift in how customers are accessing their banking services.
Unions argue the shift has been accelerated by branch staff redirecting customers to digital services.
That actually has had targets imposed on them in reducing the number of over-the-counter transactions and migrating or transferring their customers to digital platforms. So if they didn't do that, then their job was on the line.
The finance sector union says more than 300 branch closures have been announced since January last year, costing about 1,300 jobs.
Wherever they can, banks are redeploying staff into call centre functions. And technology has meant that doesn't mean you have to drive 100 kilometres from your town to the nearest call centre to keep your job. Now it's possible for people to do call centre work from their own home.
With services now at the touch of a button, there's more opportunities for challenger banks to take customers from the established players.
It's easier for the customers now to think about, I don't have to be that lawyer anyway. I've got a better options or more options in front of me.
Back in Blaney, residents are worried loyalty to local businesses will also fade if people travel to Orange for face-to-face services.
You go in there for one thing, you might as well spend half a day in there and do what you've got to do.
The local shops miss out and the town just goes backwards.
As banking moves forward into the future.
Taking a look at the share market, and the ASX 200 and the All Ordinaries both ended the trading week lower. Junbei Liu from Tribeca Investment Partners joined me for more on what moved markets this week. Junbei, the banks took a hit this week ahead of reporting their results next week.
Yeah, absolutely. We're seeing a bit of profit taking ahead of the big result. Look, the result will be fine, but we have seen investors take some profit off, as well as the bank actually is taking this opportunity to write down some unexpected significant items as well this week.
And the supermarket wars ramped up as we heard from Coles and Woolies with their results. Was there much market response to that?
Oh my goodness, I've never seen so much response to share price reactions to the supermarkets, the majors. Look, in the last little while, we've seen Woolworth outperforming Coles, in the past quarter. However, this result has demonstrated that Coles is on its way back. So despite both delivering pretty good result for March quarter, so far, Coles is definitely tracking ahead of Woolworth, and we're seeing the share price has sort of moved towards a Coles in favour.
Now, of course, it's results season in the US. What's caught your eye there?
I think what's interesting is the US reporting season actually have gone very well. Yes, we're expecting it to go well, but with such big expectations, most companies still met expectations. And especially the big tech, they didn't disappoint, which is quite different from the previous reporting season. So things are going well. It bodes pretty well for the share market.
And do you expect we'll see much market reaction to next week's RBA meeting?
Look, we don't think so. I think RBA has made it very clear in their guidance that they're not going to raise interest rate anytime soon. If anything, the inflation data we recently just saw is a little bit on the softer side. So I think we're pretty safe heading into that meeting.
Junbei Liu, thank you so much for your time.
Thank you so much.
Investment in renewable energy is heating up after a push by some world leaders to cut carbon emissions sooner. Overseas players have their sights set on Australian companies. A global bidding war for Tilt Renewables saw its share price more than double within months, and the boom times are only expected to continue. As the world's temperature rises, the amount of money being invested to cool it is racking up. And investors are in a bidding war to secure their place in the green energy race. Their target right now, Tilt Renewables.
The industry found our platform quite attractive, and our largest shareholder decided in December last year that they would see if the market found us attractive enough for them to exit.
That shareholder is Infratil, and the market did find their holding attractive. AGL Energy, the Future Fund and Queensland Investment Corporation, known as Power, and Mercury in New Zealand became the successful bidder, offering $7 New Zealand dollars 80 a share. Canadian pension fund CDPQ reportedly made a counter-offer, forcing the consortium to raise its bid, which is more than double what the shares were worth when Infratil first considered selling them.
Our passion is to change the electricity generation mix and look beyond the now.
Renewable energy infrastructure in Australia is still in its infancy. Tilt operates 8 wind farms, another one is under construction in Victoria, and a further 8 are in development. 4 solar farms and 2 battery storage facilities are also on the way.
There is a weight of shift across the world to renewable energy sources, right? And to do that, you've got to have a development pipeline. You've got to have the right priced equity to get into that development pipeline.
World leaders agree, with some setting new targets at a climate summit hosted by US President Joe Biden. But Scott Morrison refuses to set a timeline for when Australia will reach net zero emissions. And he says we'll get there by investing in technology, not taxing companies. Pressure from shareholders and society is building. Coal-fired power plants are shutting sooner than planned, and the calls for investment to curb carbon emissions is now reaching a crescendo.
I think it's a factor of the global momentum, the thematic. There's a secular trend behind decarbonisation, and a lot of companies are now not only focused on shareholder value, but all of stakeholder values.
Ben Squires is the Chief Investment Officer at NGS Super, an NGO industry super fund with almost $13 billion under management. It's switching all its investments to make the fund carbon neutral by 2030.
There'll be a lot of technology that will start to really ramp up in terms of decarbonising, particularly the materials sector and the energy sector.
And it's that technology and infrastructure that harnesses our natural elements, like the wind, colloquially known as the Fremantle Doctor, that blows through here and cools Perth on its hot summer afternoons, that's attracting big investment. Last year, Spanish group Iberdrola knocked out a Filipino conglomerate in the bidding war to buy one of Australia's largest renewable companies, Infigen, for almost $900 million. In 2019, industry super fund Rest took complete ownership of Western Australia's largest operational wind farm, Colgar. The building and construction super fund Cbus also owns wind and solar farms in WA through its stake in Bright Energy Investments. And Australian Super tried to buy Infratil for $51 billion. The offer was rejected, but it did lead to the bidding war now being played out for Tilt Renewables. More investment opportunities are on the way.
In Australia, we've seen a rapid uptake of solar, rooftop energy and projects like the one that we're standing at today.
Miranda Taylor heads up National Energy Resources Australia, a government-funded independent not-for-profit working to develop Australia's energy sector.
I think it is happening very rapidly, but I don't think there's any doubt that in the world of the future, we're going to need to see significant more investment in renewable energy.
And that means the Tilt Renewables bidding war could be just the tip of the iceberg. Australia's cotton industry is experiencing a comeback after years of drought. Production is forecast to grow to nearly 2.5 million bales this season, since falling to its lowest levels in 4 decades in 2019. And for once, it's been accompanied by strong commodity prices, as Nathan Morris reports.
After a dry decade, the Colgoa River is making a comeback. On the banks is the biggest cotton farm in the Southern Hemisphere, Cubby Station. The 80,000 hectare property has a storage capacity of 460 gigalitres. But for years, the expansive network of dams have remained dry.
It's an incredible situation after the years of drought and low production and the lack of activity on the farm, to see it come alive with water.
Last year, no cotton was planted. This season, Cubby has over 16,000 hectares to pick.
We were fortunate back February, March of last year to have a change in the season, which ultimately delivered on irrigation supplies for us, and we were able to get on and plan for a significant production.
As drought gripped growing regions in 2019, Australia's cotton crop hit its lowest level in 40 years, producing less than 600,000 bales. But production is bouncing back and forecast to climb to 2.4 million this season.
Somewhere in the vicinity of 13.5 to 14 bales per hectare as an average yield across the 16,600 hectares.
With the price of cotton around $570 a bale, millions of dollars will again flow through the district. After many failed seasons, cotton picker contractor Sophie Boschhammer is finally busy again.
We haven't been on Cubby for 4 seasons because of the drought, and so we're so happy to be back here now.
Her family business have spent recent years travelling long distances interstate for work.
So we had to downscale on our pickers because we weren't able to get the work.
Until recently, dust haunted this district.
Summer rainfall is what makes this country tick, and we basically went 8 years without a summer.
The rain has finally come, bringing the land back to life.
So far for 2021 we've had just under 400 mil for the year, which is probably the best start we've had since I've been home. Probably one of the best starts we've had in many years. The last 7-8 years, all anybody's really done is gone into debt, or for a lot of people further into debt. So, you know, it's going to take quite a few years for people to get back up and running.
And for once, the return of better weather has been accompanied by strong prices. Like cotton, wool remains very good, around $13 a kilo. After sheep numbers hit a 100-year low in 2019, production is also forecast to begin rising once again.
Commodity prices as a whole are fantastic, really. Most people that have cotton are picking at the moment.
Just down the road is Dirranbandi. The town of 600 people is back in business as an influx of workers from the cotton industry return. For more than a decade, Karina Wilson's boutique store has managed to keep trading through floods and drought.
Since the rain event, you can just see, looking at everyone, that they're just, the life's been injected back into them, and there's a good future ahead for the farming industry and for the town as a whole.
Steve Burnett has been a stock agent here for more than 30 years. It's a busy night at the Dirran pub. There's been some quiet times recently, but that's finally turning around.
Present now, like I say, we've had we're on our second cash crop season, and now people are sort of starting to look to spend and showing a lot more confidence now.
Everyone's hoping the next drought is not for another few years yet.
And that's all from Close of Business. For more on those stories, go to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern on the ABC News channel and after the late news on ABC TV. I'm Rachel Papazzoni. Thanks for watching.